Okay, let's dive right into this explainer. Indian financial markets drive one of the world's fastest growing economies. But from the outside looking in, it can honestly look like a dense, chaotic machine. So today, we're going to figure out exactly how it all operates together. We're unpacking the players, the arenas, the watchdogs, and the complex instruments they use.
Here's our quick roadmap for today. First, we'll meet the market players. Then, stock exchanges and indices. Third, SEBI, the market watchdog. 4, bonds and sovereign ratings. 5, commodities and gold. And finally, number 6, decoding derivatives.
All right, starting us off with Chapter 1, Meet the Market Players. We really need to understand the participants in the financial ecosystem.
To make sense of this market, we first have to identify the actors actually bringing the cash. The source material categorizes these investors not just by how much wealth they have, but by their specific buying behaviors. For example, you've got jobbers, who are essentially these quick turnaround traders. And then you have stags, who apply for new shares, just hoping to flip them immediately for a premium. But the real heavyweights of market sentiment? Well, they're up next.
It all really comes down to two famous opposing forces: the wildly optimistic bull pushing prices up versus the highly pessimistic bear expecting a massive market drop. A bull buys securities anticipating the price will rise so they can sell at a profit later. A bear, on the exact opposite side, believes the market is going down. And these two clashing forces, they literally create the daily push and pull of supply and demand that determines the price of every single security out there.
Moving right along to Chapter 2, Stock Exchanges and Indices, the electronic arenas for trading.
So once we have our buyers and sellers, they obviously need a secure, transparent place to trade. And here is a pretty incredible historical fact. The Bombay Stock Exchange isn't just an Indian pioneer. It's actually the oldest exchange in all of Asia, established way back in 1875. I mean, think about that for a second. Long before computers or the internet, this institution was manually facilitating the exchange of capital. Now notice the stark contrast between the historic BSE with its 30-company Sensex index and the newer National Stock Exchange, or NSE. The NSE was set up in 1992 as a fully automated electronic exchange with a nationwide presence, and it tracks the 50-company Nifty index. These indices, Sensex and Nifty, are basically the thermometers of the Indian economy. When you hear on the news that the market is up today, they're almost always talking about these two specific barometers.
Which brings us to Chapter 3, SEBI, the market watchdog, regulating the financial ecosystem.
To prevent total chaos in these trading arenas, you need an ultimate referee, and that's SEBI, the Securities and Exchange Board of India. They basically have 3 core functions. They regulate the places, like depositories and exchanges. They regulate the persons, making sure brokers, fund managers, and retail investors play by the rules. And they regulate the processes, like how a company issues new shares to the public. Essentially, if you want to participate in the Indian market, you play by SEBI's rules. But here's a serious question for you. What actually happens when panic sets in and the entire market just starts to crash? Because a free market without safety nets can lead to some catastrophic economic damage.
Well, the solution is the circuit breaker. It's a vital safety mechanism designed to literally pause trading and stop a free fall dead in its tracks. If the market drops by a certain mathematical percentage, let's say 10% in a single day, SEBI's rules trigger an automatic halt. It acts as a cooling-off period. It forces everyone to just take a breath, stop panic selling, and reassess the fundamental value of their assets.
Let's tackle another massive vulnerability. How do you stop a single person from manipulating the market with multiple hidden accounts? In the past, bad actors could create dozens of fake profiles to artificially pump up the price of a stock, making it look like there was massive demand. SEBI's elegant solution for this was making PAN cards, which are issued by the Income Tax Department, absolutely mandatory. By doing this, they ensured every single investor only has one true identity tied to their demat account. You can't trade electronic shares without a demat account, and you cannot get a demat account without your unique PAN identity. It instantly wiped out a massive layer of potential fraud. Pretty smart.
Okay, Chapter 4, Bonds and Sovereign Ratings, Decoding the Debt Market and Credit Scores. Shifting gears from owning company shares to lending money to governments, we have sovereign credit ratings. Think of this like a personal credit score, but for an entire country. If an economy is stable, it earns an investment-grade rating, meaning they can borrow money cheaply because lenders trust they're going to get paid back.
If the rating is speculative grade, well, default risks are high and borrowing becomes highly expensive. It is definitely worth noting some geopolitical tension here. India's finance secretary recently accused these international rating agencies of applying double standards to developing economies. The argument presented in the source material is that emerging markets are sometimes judged far more harshly than established Western economies, even when their economic fundamentals and stability are actually really strong. It's a fascinating debate about who exactly holds the power in global finance, and we're just imparting both sides of it here as an explainer.
All right, Chapter 5, Commodities and Gold, the physical and electronic trade of bulk goods.
Now, transitioning from paper debt to physical assets, let's look at the fascinating, highly modern life cycle of gold. It moves from a physical vault into a purely electronic format called an EGR, or electronic gold receipt, which is traded securely online. Basically, a gold company deposits physical gold into a highly secure, authorized warehouse. That warehouse generates a digital receipt representing that exact amount of gold. Then that digital receipt is listed on a SEBI-regulated exchange where your eye can just buy it. So you get the financial security of owning gold without the hassle of hiding physical bars under your mattress.
Finally, we're at Chapter 6, Decoding Derivatives, financial instruments that derive their value.
We've reached the most complex part of our ecosystem, derivatives. These are instruments that literally derive their value from an underlying asset. But to understand them, you first have to understand the spot price. This is exactly what an asset costs right now for immediate delivery. If you walk into a market, buy an ounce of gold, and walk out with it today, you are paying the spot price.
Compare that to the futures price. This protects an investor from price shocks by locking in the cost of an asset for a delivery date in the future. Imagine you're a baker, right, and you need a ton of wheat next month, but you're terrified the price is going to skyrocket by then. Well, you can buy a futures contract today that legally locks in the price you'll pay next month, regardless of what the actual spot price does. It's just a brilliant tool for managing risk.
And within derivatives, we cleanly separate out options. Unlike a futures contract where you absolutely must buy the asset, an option just gives you the right to do it. A call option gives you the optimistic right to buy an asset at a certain price, while a put option acts as a safety net, giving you the right to sell it at a certain price. If the market doesn't move the way you hoped, you simply let the option expire. You only lose the small fee you paid for the contract in the first place.
So with all these foundational pieces mapped out, from the historic BSE to SEBI's strict oversight to the incredible complexities of derivatives, we can see that India's financial ecosystem is no longer just a domestic engine. It is rapidly becoming a true cornerstone of the global financial architecture. As massive foreign capital floods in and India deeply integrates into global bond indices, we really have to ask, how will the evolving regulations they set today dictate the flow of international wealth tomorrow?